Hey guys, Dan Frio here, the rate update. Today is February 25th, 2021. Rates are spiking fast, and spiking furious. Don't go away, we're going to cover that next. Let me start the video by saying this. You're probably not going to see a lot of this on mainstream media. Not that I'm not going to say fake news or anything like that. They just don't usually do mortgage updates. They'll usually compile data Monday, Tuesday, sometimes Monday, Tuesday, and Wednesday, and they'll post that narrative or those numbers throughout the week. Where you'll probably pick up a lot of this is on the weekend, when people really dive in and dig down into mortgage rates and see where they really move to. But those out there that say, Dan, you're fear-mongering, rates are going to come back or whatever, guys, I'm going to show you right now. I have no agenda here. My job is, I look at it, and my biggest thing for this video is to educate you guys on what's going on. So my biggest followers are, well, they're consumers, which is fantastic. I'm going to go on that here in just a little bit. We have a record number of calls in today, and it's people freaking out, and I get it. But I have a lot of realtors, new mortgage people, financial planners watch my videos, and the nice thing is I get a lot of good feedback from those people. There are people that are commenting down below kind of on my behalf, but they're not me. And some of them are really great information, but I have a lot of people out there just giving information that I just want you to know it's not me. I'll comment, my little name will come up and so forth. So again, the whole point of my channel is just to explain to you guys the facts. It is what it is. If it's raining outside, I'm going to tell you it's raining outside. There's no use me saying, oh, it's sunny as all get out and it's 80 outside. Well, you know what? It's raining and it's 50. It is what it is. I'm going to tell you because it's the facts. So let's get on to where rates are, where they're going, and why all this is happening right now. So you dig into this, and the headlines right now is what's fueling higher yields, meaning higher rates. Okay, I've been saying a lot of this stuff for the last 6 to 8 months. I'm like, guys, we can't keep printing money and giving it out like it's cotton candy, and nothing happened. I mean, you can't just keep doing it and it's like, okay, everything's just going to be fine. Well, no, because massive stimulus packages are going to create higher yields. Those higher yields are bank accounts, car loans, also in CDs, good news, your not mutual funds, money market accounts, and so forth. So there's good news behind some of this, but there's bad news for those that are looking for money. Okay, if you have money, you want higher yields, higher rates of return, but if you're looking to borrow money, you want it as low as you possibly can. Well, that's what happened through this pandemic. We shut down half the country, pumping the system full of stimulus and dropping rates to the lowest they've ever been in history. Okay, I've never seen it before in my life, and I hope to never see it again. It was a great year for us in 2020, basically a record year. We blew out numbers about 4 times what we expected, but it comes with a cost. Okay, so I even tell my sales guys and girls, don't expect a 2 to 2.5% 30-year mortgage rate for the duration of your life. Okay, it's not going to happen. It's there because the country, the economy is in turmoil. All right, so that's one reason. Strong rebound. I've been saying too, I expect a V-shaped recovery come spring and summer. I still do. I think the GDP is going to blow out numbers by the end of the year. So everybody's now saying, oh, we should have a strong economy or a rebound. Inflationary fears. You can't keep printing money and giving it away and not have inflation. You have excess dollars going over a finite amount of items, causing those prices to go up. It's basic economics, supply demand. Eventually, the Fed has to taper, meaning they have to cut back on a lot of their bond purchases and everything that's keeping rates artificially low, and that'll increase rates. And they control the federal funds rate, and they're going to eventually have to hike their rates. They did come out 4 or 5 months ago and said, you know what, we're going to keep rates low, basically at zero till 2023. Go back to my videos and watch what I said. I said, you know what, once the economy starts to kick in, they're gonna change their tune. They didn't do it at the time because they didn't want to spook the markets, but they got to do something. They can't let everything run out of control, especially inflation. So that being said, what happened to today's rates? Okay, guys, close your eyes. I'll tell you when to open them up because you're gonna be sick to your stomach here in a second. Okay, open. Yep, this number, I didn't put it in there. I didn't plug it in. I didn't override my computer system. We are down 114 basis points. That is one of the biggest adjustments I've ever seen in my life, other than there was 2 other occasions. This is one of them right here. This is when the pandemic hit, right there. And then we recovered fast. Why did we recover fast? Well, basically the government came in and said, we're going to do everything and anything we can to help the economy, because we knew everything was going to shut down. The Fed stepped in and started buying mortgage-backed securities and stabilized that market and did a fantastic job. Look at that. Basically no moves since July, August of last year. So now what's going to happen? Well, as the economy recovers and gets better, rates can go down, okay? Thank goodness the Fed is still in there buying $20 billion worth of mortgage-backed securities on a monthly basis, because if they weren't, we would be down here, okay? And everybody would be freaking. So the Fed has no plans in the short term to stop buying mortgage-backed securities. So that's going to put a cap on these losses eventually. Where that is, I don't know, and I'm being honest with you. This bloodbath should not continue. We blew through all the technicals, so let's get back to those technicals. All these lines here are there for a purpose. These are called Fibonacci levels, and these are resistance lines, and the resistance lines are ceilings and floors. So in a normal market, we should be trading, between these bars here. Just think of these when you take your kids bowling when they were really little. You put up the bumpers. So you put up a bumper here and you put up a bumper here, and when they threw the bowling ball, it just went ding, 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 ding. That's basically what happens on this thing. Well, we blew through, the bowling ball flew through this bumper. Well, we had a secondary bumper here. Well, we blew through that in a day. We had another bumper here. Well, we blew through that in a couple days. Guys, it's, you can watch any analyst you want, and if they tell you this, it's going to stop right here, it's going to move over to here, it's a guess at this point. When I'm going through technicals, so how I usually monitor this whole system is I'll follow a multiple of technicals. Those technicals are GDP, inflation, unemployment, employment, freight indexes, gross domestic products. A whole slew of things is what I normally, in a normal market, I'll monitor and say, okay, this is heating up, that area is going to push, freight index is going down, employment's going up and down. So I can give a guide on saying, okay, based on all this information, here's where we should be trading in regards to mortgage rates. Well, when all that's thrown out the window, because we have record high unemployment, or basically you shut down half the country and then say, okay, now figure it out. You can't. So everybody was hinging everything on the stock market, everything on, the economy is in turmoil. So COVID relief, meaning what's going on with vaccines, government assistance. That was in the Fed, what the Fed's doing. So on those 3 things, they did, the vaccine's coming out and is doing fantastic. Every drug company's out there trying to make the vaccine. We're going to have a glut of vaccines given 3 more months. There's going to be too much. There's going to be oversupply. Okay, that's one. You go through, people are going back to work. I was flying last weekend. The airports they're getting really crowded now. A month, 2 months ago, 6 months ago, you'd walk through the airport, especially at O'Hare. It's scary. You're the only one there. Food courts are packed. Restaurants are starting to get packed. You got all that. Now you're going to have, once everybody gets the vaccine, we can go back to work. Kids can go to school. Moms can go back to work. Dads can go back to work. Everybody gets back to all that. Now, the pent-up demand, you got people in there and they got this stimulus money. They're back to work. They're like the households have a record low debt right now, and record high equity built in their homes and in their retirement accounts and in their assets. What are people going to do? They're going to feel a little more comfortable, and they're going to say, you know what, I felt like I was in a prison the last year. I just want to go do stuff. I want a vacation. I want to fly somewhere. I want to go to the beach. I want to do this. I need a new car. I just want to splurge on myself because it's just, busting out of your cocoon. So because of that, sorry to dwell on this, but I just want to explain to you guys, the economy is doing better. You're back to, we don't need the Fed in the system to artificially lower rates because it's not needed. We love it. Awesome. We do love it. But it's not, it can't be sustained, and you can't keep going. You can't keep doing that because inflation would just go to record highs, and you don't want that as well. So basically, the Federal Reserve, their mandate is to control inflation and work on maximum employment. That's the reason why they were created, were those two things. All right, so now let's get back to this. So right now, I'm gonna show you what's going on. There's basically a bloodbath here going on. It's got to stabilize. There's an equilibrium on anything. No matter what you have, there's supply, demand, and this will hit a point where it stops. The scary thing is we got another $1.9 trillion stimulus package going out tomorrow. So that's even going to make things, inflation worse, yields higher, and so forth. So where this is going, I hate to say it, and I've been watching economists the last 2-3 days, and everybody in my whole office is coming to me saying, Dan, what's going on? Guys, I don't know. And I'm doing as much research as I can. There is just a complete bloodbath in the bond market, and that's what's going on right now. So I err on the side of caution. Every client we have is locked unless you put in your application today. Okay, and I'll continue to monitor this on a second-by-second basis. What happened today intraday? Well, we drop. Here, this was scary. We hit a 99.5 resistance level, and thank goodness from that, we stopped. Okay, and we recovered a decent amount. The bad thing is it weakened, strengthened a little bit, but we ended the day on weakness. It's not a good note to end in red, because red means there's more sellers than buyers. And as there's sellers and sellers and sellers, the price goes down. So this isn't a good indicator right here. Market wrap, basically if you go through, I'm trying to find you just the point in here where I really want to focus in on. Where is it? Yield on the 7-year, so forth. U.S. Treasury curve, the highest. Basically, and now let's not go over this. I don't want to end it. I don't want to go through this whole thing like doom and gloom, guys. Money's still cheap. It's still crazy cheap. But this auction, they auctioned out off bonds today, and it was the weakest bond auction basically in the last 7 years. So that means prices are going to continue to go down because there's a finite supply, and when you have very, very extremely weak demand, it continues to push down the prices. Thus, we saw this and this. Okay, so that's what's going on there. Economic calendar, actually not bad news. GDP, right in line. Initial jobless claims, better than expected. Continued jobless claims, better than expected. GDP, gross domestic purchase index, right in line. So nothing here should have shocked the system. So again, myself, as well as a lot of economists and a lot of mortgage professionals, were kind of stumped by what's going on right here. I feel personally we should be trading right about here at this point. And I don't think we're going to get back up to here like I've been thinking. The stimulus package still has got me for a loop, but we should be, let's say, we should be between where we are now and the lows. So we should be stabilizing in the range of about 3.25 on rates. I talked to 5 people today. Every one of those had a rate between 4.5 and 4.875. My comment to many of them is, where you been? But many of them have been in forbearance, and they're coming out of forbearance at this point. And I want to address that here in a minute. But let's keep going. What happened? These are not my rates. These are generic. These are average rates throughout the whole country. So I have people saying, hey, Dan, this rate or that. These aren't my rates, guys. These are the generic rates throughout the country. It's Black Knight posts these every day, and I get a copy of it. It goes over the 30-year conforming, jumbo, FHA, and VA. Here's where the rates are. A difference from yesterday. Well, 3 basis points. 3 basis points is really nothing. This is going to change tomorrow. You're going to see this number being much more. Okay, I've seen rates go about 0.5% higher today than where we were about a week and a half, 2 weeks ago. 0.5% in a week. That is huge. This isn't reflecting a lot of these adjustments just yet, but they will. A one-day delta it means a one-day change. So this 3 basis points is 0.03. So 2 basis points is 0.02. So that's the difference where we've gone in a day. In a week, here's where we are. In 4 weeks, in a month, we're about 0.25% higher is what this is saying. This is going to change to about 0.5% once this updates and gets completely current. So that's what's going on in the mortgage market. So I just did a video today that'll be being posted next week. Forbearance. Now let's talk about forbearance real quick. If you're in forbearance, I'm not even going to go through the technicals, the guidelines, or anything with you. All I'm asking you to do is call us. We'll do a free consultation. It is not a sales tool. It's a sales tool for us to hopefully we get your mortgage. I'll be honest with you. So some people say, "Oh, Dan, yeah, I'm trying to get you to call. I'm trying to help you though." Because what we want to do is we want to look at your situation. If you called me, and if you talked to me today, you can vow this. Please put a description down below if I talked to you today, saying, "Hey, Dan, yeah, you talked to me, and I told you my rate was 4.875. That was one of the first things I asked you. Please post down below. I'd love to hear you to comment. If you said, Dan, my rate's 2.25, I'd be like, dude, God bless you. Most likely, keep what you got. I don't care what you have to do. Throw the payments at the end of your loan. Try your best to add extra payments to your payment each month, or add extra dollars to your payments each month to get you caught up, because that rate is fantastic. My job isn't to put you in a worse situation. If you're at 4.5%, 5%, and I can get you 3%, what do you think I'm going to say? So you have a deficiency balance. You have a rate that's 1% higher than what I can get you. I can lump all that together and probably drop your payment down from what you have now. It's a win-win-win. So again, if you're at 2%, I'm not going to tell you. I'm going to say keep what you got. You're at 5%. Let's do everything we can to get you refinanced. I'm not saying it's that simple, but those are the avenues I need to go down with you. Guidelines are changing by the day when it comes to forbearance. The government is getting involved because they're like, okay, we don't want to leave it up to specifically the banks alone, because the last time this happened in 2010, the banks took advantage of a millions of people in their modification programs. This time around, I don't think the government is stepping in saying, here's things that you need to do. And we learned from the past. We bailed you guys out last time, so you need to go over. You need to do these things that we're laying out for you to keep your federal programs coming your way. So the thing I'm going to ask you is, if you're in a forbearance and it's coming due soon, pull your head out of the sand. I know it's scary. I know you got family. You missed 6 months, 12 months of your mortgage payments, and you're like, what's next? All I'm asking you is just call us. Almost every one of these files make it to my desk for review or a final, okay, yeah, that's what I would do. So you might talk to me, you might not talk to me. I'd love to talk to you guys if you do call in. But that's what we're doing. I'm just basically saying, call us. I talked to 3 different people today and said, you know what, I'm reaching out to my underwriting team right now, because I know there's changes once this new COVID package goes into effect tomorrow that the government's going to put into it. I think it's Care Package 2 or 3 or whatever. It's probably going to modify or change up this forbearance terms and guidelines anyways. So it's a moving pendulum. So I want to make sure I get the most recent and current and up-to-date information for you guys. So that's why I really need you to call me, because 3 months ago, you had to make 12 payments before you could refinance. Then it went to 6 payments. Then it went to 3 payments. There's a lot of programs right now that you don't have to bring your account current. As soon as your forbearance is up, we can refinance you. Many of them, we can do it without an appraisal and without income verification. So it's just a matter of paperwork. We get you closed. And then from that point too, you could skip 1, maybe even 2 months after we refinance you. So there's a lot of things we can help you with. So that being said, my name is Dan Frio. What I asked you to do is, I apologize, this was a lengthy video. Give me a thumbs up if you like the video, you're learning some stuff. Please hit the bell down below. Subscribe over to the side so every time I post a video, you get an alert. But you're like, Dan, how do I get a hold of you and your team? Great question. So what I need you to do is go to the web and plug in the rate update. Not the rent update, the rate update. Scroll down to the bottom. This is my 800 number, 844-775-LOAN. It's 844-775-5626. Email me at dfordanfrio@preferredrate.com. Or you can go here and you can hit apply now, get the ball rolling there. If you're looking to buy a house, get pre-approved, click the purchase qualifier here. You're looking to get a refinance and you're like, Dan, I just want to put in the application, hit this refinance checker right here. Or if you want to get a call or email conversation with me or one of my team, click here. Get a free quote. Basically, that just gives us your information and you tell us how you want us to reach out to you. So that is it for today. I'm going to go from there because I know it was a longer video than I expected, but I wish you the best. Keep warm, be safe, be happy. God bless, and I'll see you tomorrow. Bye-bye.